Index funds versus mutual funds. Which should you choose? Hey guys, today we're going to talk about which you should choose, index funds and mutual funds. Let's get right into it. It's easy to get mixed up between the terms mutual fund and index fund. The two terms refer to distinct categories. Mutual fund refers to the structure of a fund, whereas index fund refers to the investment strategy of a fund. Many index funds, but not all, are structured as mutual funds, and many mutual funds are index funds. However, in general, an index fund is a fund whose investments closely track a market index, whereas a mutual fund is a broad class of investment funds that follow a variety of investing strategies. A financial advisor can assist you in understanding the similarities and differences between mutual funds and index funds, allowing you to make an informed investment decision. But first, what exactly is a mutual fund? The word mutual in mutual fund refers to the type of fund structure rather than the investment strategy pursued by the fund's owners. This type of fund pools the funds of investors who pool their funds to buy and sell securities. Investing in a mutual fund involves trading shares of the mutual fund company rather than specific companies held by the mutual fund. Investors buy and sell mutual fund shares at the end of a trading session. Their value does not fluctuate during the trading session. Investing in a mutual fund can provide a variety of advantages. It can provide higher returns if properly managed, and there are numerous options available to help you meet your investment objectives. What exactly is an index fund? The term index fund refers to a fund's investment strategy. It is a fund that seeks to replicate the performance of a specific market index, such as the S&P 500 or the Russell 2000. This is distinct from an actively managed fund in which investments are chosen by a fund manager in an attempt to outperform the market. An index fund seeks to match, not outperform the market. This type of fund can be structured as a mutual fund, as previously described, or as an exchange-traded fund or ETF. Unlike a mutual fund, the value of an ETF fluctuates on a public exchange during a trading session. In comparison, a mutual fund investor transacts with the mutual fund company by purchasing and selling a stake in the company. ETF investors, on the other hand, transact with other investors by purchasing or selling shares of the ETF itself. Investing in an index fund can provide a variety of benefits, including lower fees, more consistent returns over time, suitability for novice investors, and strong diversification. Aside from the distinction described above, index funds and mutual funds typically have three major differences. These distinctions include how decisions about a fund's holdings are made, the fund's goals, and the cost of investing in each fund. Here's an explanation of each differentiator and how it may or may not apply to you. The first is a comparison of active and passive investment management. Many mutual funds, but not all, are actively managed. This necessitates daily or even hourly trading decisions by the fund manager. An index fund, whether in the form of a mutual fund or an ETF, takes a more passive approach. Because an index fund tracks the performance of an index, there is no active fund manager. Index funds seek to buy and hold securities that correspond to the indices that they track. As a result, there is no need to buy and sell securities on a regular basis. This is one of the most significant differences between index funds and mutual funds. Because there is no active fund manager managing an index fund, the fund's performance is solely determined by the price movement of the fund's shares. However, the performance of an actively managed mutual fund is determined by the investment decisions made by the fund managers. Fund managers are free to select securities that best meet the fund's investment objective and character. The debate over whether actively or passively managed funds are superior is ongoing. Within 5 years, 78.52% of large-cap funds underperformed the S&P 500 according to SP indices. This demonstrates that even though the market has been volatile in recent years, active funds do not always produce better performing funds. The investment objective comes next. Another distinction is the investment objective that each type of fund provides. The goal of index funds is to simply mirror the performance of an index, whereas the goal of a mutual fund is to outperform the market. Actively managed funds, in essence, select investments that will yield a higher return than the market. Investors seeking above-average returns may be drawn to mutual funds. However, because actively managing a mutual fund requires more work, it may cost more. This brings us to our next major distinction. Finally, consider the cost of investing. Running an actively managed fund is typically more expensive than running an index fund. This is due to the fact that actively managed funds have higher expenses such as fund manager salaries, bonuses, office space, marketing, and other operational expenses. Typically, these costs are borne by the shareholders through a fee known as the mutual fund expense ratio. It's important to remember that the higher the investment fees, the lower your returns will be. You may be disappointed if you buy shares in an actively managed fund expecting above average returns. especially if the fund underperforms. Index funds, on the other hand, have fees, though the lower cost of running such a security usually results in lower fees. That's all for today, and we'll be sure to catch you all in the next video.